If you read Western news or watch financial reports, you hear the same story over and over. China's property market is collapsing, consumption is too weak, and the whole economy is heading for disaster. But here's what doesn't add up. If you look at daily life in China, nothing seems to be falling apart. People still go to work, buy car, buy appliances, travel, send their kids to school. No lines at bank, no mass evictions, no empty cities everywhere. So what's really going on? Is the story true, or is there a huge gap between headlines and facts? Today, we'll break it all down clearly. Let me be honest upfront. The property downturn is absolutely real and painful, but the economy-wide disaster that was so widely forecast simply hasn't shown up. Over the next few minutes, I'll walk through what actually happened, why China's system absorbed the shock differently from Western crash, and just as important, what real risks still remain. Let's start by considering what's true, because this part isn't a myth. In 2021, Evergrande, the world's most indebted developer, defaulted, owing more than $300 billion. In 2023, Country Gardens, the largest private builder, went the same way. And in early 2024, the Hong Kong court ordered Evergrande liquidated. Property investment fell almost 10% in 2023 and again in 2024. So the sectors generally cracked. The stall project, falling prices, failed developers. So the real debate isn't whether property is hurting, it's whether that pain spread into a full economic collapse. Here's why the collapse call felt so reasonable. Property isn't a sideshow in China, it is central. Cutting the supply chain is roughly a fifth to a quarter of GDP. And for ordinary families, it's about 70% of their wealth. Most of the savings are literally in the walls of their home. You can see the scale of adjustment in one number. Housing investment fell from over 12% of GDP in 2020 to about 6% in 2025, cut in half. A shock that big to something that important should have been catastrophic. That's the logic behind the doom forecast, and exactly why the next slide is important. In China, it's completely different. Most buyers put down 30 to 50%, sometimes even more in big cities. That means they already own half or more of their home from day one. Even if prices fall by 20 or 30%, they still have plenty of value left. They will not give up and lose years of savings. Add to that very low mortgage rates, only 3.1 to 3.8% right now, compared to 5, 6% or even higher in the West. Money payments are affordable, and banks are told to protect families. They rarely foreclose on people living in their own homes. The result? The default rate on home loans is less than 0.5%, almost zero. No crisis for ordinary household. So who is actually losing money? Private developers like Evergrande and Country Garden, and the foreign lenders who funded them. For years, these companies borrowed billions by selling high-interest US dollar bond, paying 8% to 12% a year. Investors on Wall Street in Europe and across Asia bought them, assuming the Chinese government would bail them out if things went wrong. But when Beijing tightened rules to stop debt from growing, the money stopped. Developers could not repay their loan, and the government made its choice clear. We will protect home buyers, finish half-built apartments, and keep our own bank stable. But we will not bail out foreign bondholders. Today, those investors get back only 2 to 8 cents for every dollar they lend. So let's correct the story. This is not a collapse of China economy. It is a collapse of a risky business model and a lesson for those who ignore the risks. Once these investors lost money in China, they didn't stop. They just moved their capital somewhere else. This is what we call hot money. It has no loyalty, no political agenda. It only chases fast profits. The pattern is very clear. In 2021 to 2022, they pulled money out of China and then labeled it uninvestable. Then in 2022 to 2024, they rushed into India and Indonesia, calling them the next great growth miracles. Then in 2025 to early 2026, they shift again to South Korea and Taiwan, calling them the winners of the AI and semiconductors boom. But by mid-2026, they take the profit and sell off and suddenly warn that these markets are too risky. Think about it. The countries did not suddenly fail. Their economies did not break. The only thing that changed was where investors wanted to make their next return. This explains why collapse stories keep appearing in different places. It's never really about the country. It's about where the money is flowing in and out. Another common claim is China consumption is too low. That's why the economy is weak. On paper, this looks true. Household spending makes about 40% of GDP in China, compared to around 68% in the US. But these numbers are very misleading. There are two big reasons why. First, most families already have everything they need. Over 90% of the household own their home: washing machine, air conditioner, refrigerator, and smartphone. There are more than 50 cars for every 100 households. Once you own this thing, you don't need to buy a new one every year. When a market is fully supplied, growth naturally slows down. That's maturity, not poverty. Second, the price of services is completely different. GDP measures spending as quantity multiplied by price. If the same service costs less, it shows up as lower spending, even if you get the same result. Look at this example. University tuitions fees is about 800 to 1,002 per year in China versus 35 to 55,000 in the US or Australia. The doctor consultation fee is typically $8 to $15 in China versus $50 to $300 in US or Australia. For hospital stay, it's also cheap, around $30 to $80 per day versus $500 to $2,000 or more in US or Australia. So when prices are inflated by insurance costs, huge admin fees, legal expenses, and profit margins, more expensive does not mean better quality. It just means a more expensive system. So when you hear consumption is too low, what it really means is people living well but pay much less for what they need. It's not a weakness, it's just a different way of doing things. If money is not going into more property or short-term spending, where is it going? The government has made a clear long-term decision: invest in future strength rather than short-term gain. First, they are pouring resources into R&D and high technology. China now spends 2.8% of its GDP on research and development, close to the level of US and Europe. The focus is on semiconductors, AI, EV, and renewable energy, and advanced manufacturing. The goal is to build industries that will create stable, high-paying jobs for decades, instead of relying on debt and construction. Second, instead of building more luxury apartments, the priority is improving living standards. They are upgrading old housing blocks, adding elevators, fixing water and power system, and building better schools, hospitals, and public transport. It's about quality of life, not just numbers on a spreadsheet. So, the story that rarely makes the headline: as property shrank, new engine pick up the slack. Clean energy technology hit 10% of GDP in 2024 and is now bigger than real estate sales. It drove roughly a quarter of all growth that year. And China now attracts about 3/4 of the world clean tech factory investment. The shorthand is the new three: solar panels, EV, and batteries. So the economy isn't just surviving property's decline. It's actively shifting its center of gravity towards manufacturing and green technology. Let's put it all together. The property collapse is a problem for developers and foreign investors, not ordinary Chinese families. The low consumption crisis is mostly a trick of statistics and pricing. It's not a sign of economic weakness. The moving stories of collapse follow the money, not the real health of the economy. So China is not falling apart. It is going through a major adjustment, shifting away from debt-fueled growth towards a more balanced and high-tech future. So the honest headline isn't China collapses, it's China rebalances.